What makes us more profit? Dividend investing or vanilla index investing? Well, today we're going to find out because we're going to conduct a little experiment with my own portfolios that I'm going to fully reveal to you. So I'll show you 2 or 3 of my own personal accounts and use them as guinea pigs. One is a dedicated dividend account that I use with Robinhood. The other 1 or 2 that we're going to go over are these long-term accounts that I've had for a long time that are strictly index funds. Not only that, we'll also use an online tool to backtest some of the highest performing dividend stocks in the last year and see if that ideal selection of only the finest dividend payers can beat a basic index fund. Hey, I'm Brendan, and if you're new here, I make videos about personal finance and investing. My wife and I became millionaires last year at 37 years old, and sometimes we talk about dividends. That's today. So first off, I'm going to show you my dividend portfolio and exactly what my returns have been over the last year. I've got my dividend account with Robinhood here pulled up, and you can see that today was an amazing day. 1.11% today. That is ridiculous. Over the last 3 months, 6.2%, and year to date, 7.5%. The last 1 year, 11.75% returns. And of course, this is showing us total return. This isn't just price return. And so this includes the value of the dividends I've gotten. And if I had to average out the dividends I've gotten over the last year, it's probably been 7%, I don't know, 6, 7%. And so a little over half of the total returns I can see right here are actually from the dividends themselves. Probably only about 5% of this is actual price appreciation, like the value of the dividend portfolio itself going up. But overall, I don't know about you, I'm pretty impressed. For a dividend portfolio, that's pretty awesome. Up until recently, I was an idiot and I didn't realize that price return was different than total return. And so I didn't understand that this number of 11% doesn't then get the dividend put on top of it. It includes the dividend. So just make sure in your own calculations that you get that part right. So is this enough of a return? Should we be happy with this? Well, typically the stock market overall averages 8, 9% per year. So we're already beating that. If your money grew at 11.74%, every year, year after year for a decade or 2, you'd be sitting really pretty. It would be awesome. So objectively, yes, I'm happy with that. I don't expect any more out of a dividend portfolio than this, but now we need to look at the index funds and compare because the last year has been quite the bull run. So maybe the index funds have done better. Let's see. Let's take a look at my traditional IRA account that's hosted with Vanguard. Now there's no special power with it being at Vanguard. It doesn't mean that I'm automatically getting higher returns there. It's just a decision that I chose years and years ago to put it there. Oh, there you can see. March 1st of 2018, I opened that account. So it's been almost 6.5 years just sitting there, slowly growing over time. I haven't contributed a whole ton, but it has gotten some good growth. And in the last 1 year, compared to the 11.7% our dividend portfolio has gotten, this portfolio has experienced 16.6% growth. That is ridiculous. It's amazing. So if I open up this slightly different view, you can see that as far as my returns go, it's not been all gravy. I was actually down a little bit in October of last year. I was down $1,400 as far as cumulative returns over the last 1 year. But since then, it's been such an amazing run and we've gone up and up and up all the way until now where we're up $4,500 in the last year. And you can see my activity has been nothing. I've contributed no money in the last year. I've done nothing with the account. It's just sat there and grown on its own, totally passively. And then there's a view of the balance. So then the next logical question is, what is it actually being invested in this account? And why is it so much better than my dividend portfolio? Well, for this one, I picked VFIFX. This is a target date retirement fund. And if you're not familiar, a target date fund is basically a mix of different investments that automatically changes itself over time. And so the closer you get to your retirement year, the more conservative it gets. And it's a slow transition over time. So if you started this in like 2010, it would have been really, really aggressive because it was a long way away from your retirement date. But the closer you get to that retirement date, the less equities you get, the more bonds and cash and conservative stuff it switches over to. And so it's doing all of that for you. That's typically what people like to do whenever they invest. I'm not saying that's what we should do. I'm not saying that's how you get the most return. If anything, that's not how you get the most return because it's not as aggressive as you could be. If you just stayed at your original mix, you'd be a lot more aggressive. You potentially set yourself up for more growth. But a lot of people like to kind of lock it down whenever they get older. They don't want to have to deal with that risk of loss. And so way back in 2018, I picked this. I haven't changed it since then. It's done well so far, but there's actually a chance that I would change that in the future because I want to stay aggressive. I want to stay with this stuff growing and growing as much as possible because I don't think there's actually that much of a benefit to me switching to cash and bonds and basically really conservative stuff. And all the forecasting and the projecting that I do intends on me getting essentially the market average return. I need to get somewhere between a 7 and 9% return for all my retirement projections to work, for my safe withdrawal rates to work, for everything to kind of slot into its spot the way it's supposed to. So I can't actually afford to have such conservative investments as this is probably planning to switch me into. So as of the middle of 2024, the asset allocation is still very aggressive. Like we're still a long way away from 2050, which is the retirement date, kind of end date that we're targeting here. So I'm still almost 90% stocks, only basically 10% bonds. And so it's still pretty close to my desired mix, but every year, this gets a little bit more bond heavy, a little bit less equity heavy. And so over time, I'm probably going to get more and more annoyed with this, and I'll have to change it in the future. But for today, it just felt like a good example of a one and done index fund. What's the easiest possible way you could invest for your future, not have to think about it, not have to pick a dividend stock or anything else like that. Just set it and forget it. That's a good example of one. So these returns are almost exactly 5% higher than my dividend portfolio. And I know there's going to be a lot of people out there that go, well, but this didn't put off a lot of dividends. This wasn't giving you income like you might have wanted with the dividend portfolio. And so it doesn't have the same features and benefits and things that you would look for if you were looking for dividends. And to that I say, yes, that's very true. There's a chance that there's something there that you wouldn't have gotten with this. But if I needed income from this, I could have just sold little bits of it. Like let's say I was looking for $100 a month, which is fairly close to what I'm getting with the dividend portfolio. I don't have to rely on a dividend getting kicked off. I could always just say, hey, Vanguard, sell $100 worth of this fund. Give me the $100. Like there's no definitive, unique thing that a dividend delivers that you can't also just get from withdrawing something like this. Now, granted, the dividend portfolio is in a taxable brokerage account, so I'm allowed to withdraw that and not have any penalties, not have any early withdrawal problems like I do with traditional IRA. This money's effectively locked up until I'm at traditional retirement age, which as of right now is 59 and a half. If I try and touch this money before then, because I've already gotten a tax break on the contributions that have gone in here, I get slapped on the wrist by Uncle Sam. I get a penalty. I have to pay taxes on it. Like the whole thing just kind of comes crumbling down. It's not worth touching this money. But that's not so much about the investing philosophy of dividends versus index funds. That's more about how I've placed this money in the account. But that's not the best performing account that we've had. I wanted to show you one more and show you what a different kind of smattering of index funds can do if you're more aggressive. So this little sweet thing is my wife's Roth IRA account that we have with M1 Finance. Look at that ridiculous return. 23.72% in the last year. That is double the dividend portfolio. That is crazy town. If you had 23% returns every year, that would be amazing. You'd be shopping for sports cars and second houses in your retirement. You wouldn't be worried about what's on sale at the local grocery store. Holy moly. And this is consistently our best performing account. It's so funny too, because I was going through different kind of investing philosophies at the time that I set this up. And so I picked a smattering of different index funds and just basically went, yeah, this seems to make sense to me. Like, it doesn't have to make total sense. It doesn't follow a particular philosophy. Just to me, in that moment, I thought it seemed like a well-balanced idea to put things in here like this. So it's 55% VTI, 18% VUG, which is the Vanguard Growth ETF, 12% the total bond market fund, 9% international, and 5% ESG. And somehow that's just been this crushing combination for the last couple of years. Now, this is not investment advice. This is not me telling you to put your money in something like this because I have no way of knowing what's going to happen in the future. I don't know what you should do for your life and your goals, what you want to do with the money, when you want to do it. You know, are you 18 years old and saving for retirement? You think you're going to retire when you're 70 because people are living longer? You should be healthier. You should have a healthier lifespan and health span than I do. Or are you 68 and a half years old and you're going to retire in 3 months? Like, I don't have the right to map that out anyway, but especially because everyone who's watching this video is so diverse, there's no way that I can make any recommendation to you. If you have somebody online who's telling you exactly what to buy, they're guaranteeing you results. You've got to buy this now because it's going to skyrocket in value. I personally would not listen to that person. They're at least overpromising when they shouldn't be, and they might be as bad as a shyster, swindler, dishonest, wanting to take advantage of you kind of person to say, let me just make these promises so that it sounds good so that people watch my video. That's not the kind of person you want to listen to. I'm not saying that I'm wiser or smarter than anybody else out there. If anything, the opposite is true. This is me just sharing results with you, sharing what has happened in the past, which is no guarantee of what's going to happen in the future. And now the time has come to test my 3 portfolios against a mix of the top 10 dividend performing stocks of the last 3 months in 2024. So what we've done is we put them into Portfolio Visualizer. Each of them has an equal percentage in the portfolio, so they're each 10% of a portfolio. 10 times 10 is 100%. And here they are, in case you're curious to know which companies they were. And we're testing them over the same exact time period that we just tested the other ones, the last 1 year. So from June 2023 to June 2024. This little example is to say if you had $10,000 in the account, how much would it grow? And my, oh my, would it grow? Portfolio growth went from 10,000 to 13.5 in the sample portfolio. And that's because it grew by 31%. Oh my gosh. So, as an example, as just part of this video series, we can honestly say that if you pick the very, very best dividend stocks in the entire country, then you'll beat even a pretty modest index fund portfolio. The tricky thing is having the crystal ball to be able to pick the very best stocks. Is it possible? Yes. Is it likely? No. And historically, from what I understand, despite what he talks about in this book, and this book is The Income Factory by Stephen Bavaria. It's a fairly popular book as far as dividend investing goes. What he really tries to do is point out that there are distinct benefits to dividend investing that you can't get just from a strictly growth portfolio, and that companies that pay off dividends have unique benefits. And he's trying to kind of lay all that out in a way that incentivizes you to invest the way that he does. But even then, he's really critical to say that he's not guaranteeing a higher return. He's not saying just by the numbers statistically, watch the graph go up, I will beat those guys over there. He's not saying that, which I really appreciate. And here's how he defines an actual income factory. He says, an income factory advocate does not claim it's better than traditional investing strategies or that will generate higher returns. Its primary advantage is psychological and emotional. He talks about how investors don't like the roller coaster of growth-based investing because a lot of times you've got really amazing years like we've had where you've got 16% or 23% growth, and then the next year, maybe you're down 10%. And that feels really crazy. And he says that this strategy in turn makes it less likely that investors will lose their nerve and cash out during stressful periods. So we've got to take that into account too. I know a video like this is interesting because one portfolio made a lot more money than the other. And so of course we're weighing those options in our mind. We're deciding what we want to do. But to take into account the psychological factor of what keeps us engaged, I think is equally as important. Like for example, I've had a really hard time maintaining a kind of healthy lifestyle lately. I do not want to exercise. I don't want to eat healthy. And so for me, the psychological game of what can I actually motivate myself to do is a lot of what will make me win in the end. If I can be motivated enough to ride this bike back here for an hour a day, great. I'll burn a bunch of calories. I'll get my blood pumping. I'll release a bunch of healthy chemicals in my brain. Everything will be good in that way. But if I can't motivate myself to stay in the game and do that, it really doesn't matter what the ideal exercise regime would be. It's very similar with investing. If we can't motivate ourselves to do the thing and to stay in the market and to make the kind of logical decisions that will make us money in the long term, kind of doesn't matter if what we're doing is ideal or not. I don't know if that was a bad example or if that made sense. I think ultimately investing is a lot like most significant relationships in life. 90% of it is showing up. Be there, make yourself available, show up for the people around you that you love, and you actually have a good opportunity to have a relationship with them. Investing is similar to that. If an income factory strategy makes you really excited and also feel at peace, hey, you're investing, you're showing up, you're doing the thing. If growth makes more sense for you and you like an index fund and you want to keep it simple and do something like that VFIFX fund, by all means, do what you like. Whatever helps us to actually show up with our money, actually deposit it, actually make those investments happen and not forget to invest the money, that's what we should probably do in the end. We just don't want to get stuck in analysis paralysis and always looking for the ideal strategy and never actually taking action. Ooh, that was a great quote today. I need to look that up for you. James Clear in his newsletter said this today: the first minute of action is worth more than a year of perfect planning. If you're not investing yet, it might be best to just get started. As imperfect as it may be, getting started changes everything. And on that note, the secret comment word for today will be start. I appreciate you guys so much for watching. Thank you, channel members, for being members, and I'll see you guys Monday. All right, bye.